Hey you. Hi everybody. Okay, everything is running nicely and smoothly. So let's just begin. So welcome guys to another webinar of our series. Again, this week we're going to go down the technical analysis path yet again. And today we're going to discuss one of the most insightful technical indicators, at least to my opinion, which is called the average directional index, or in other words, the ADX. I find it super helpful in order to gauge who is in control, either the bulls or the bears, and how much or how strong their momentum is given any given point in time. And at the end of the day, we're going to discuss how um, what kind of information this kind of indicator is conveying, what are its basic components, and lastly, we're going to discuss how to interpret its signals or its values or its results or however you want to call it in order to get a glimpse of what the market or how that specific instrument is behaving, who is in control, and how we can benefit from it by studying this kind of information that is conveyed. Okay, so this is a quick risk warning and a disclaimer. I'm not going to go over this. At the end of the day, what is projected in this kind of slide is that there is no investment advice or investment recommendation in this kind of webinar. It won't be anyways. And the redistribution of this material is strictly prohibited. This is purely for educational purposes only. So ADX, before we go into ADX, let's just visit this kind of not graph, but this visual illustration of what we're talking about here. We talked earlier on this throughout the series that we are going to venture a lot more deeply into the technical analysis aspect of things rather than the fundamental aspect of things. We have covered fundamental analysis in the past on a super basic and understandable level. We're going down the path of technical analysis this webinar as well. So we're going to go down the path of mechanical analysis more specifically, which has a lot of technical indicators as its primary kind of components, if you would like. So off-chart indicators are the ones that you can find on the bottom of the price chart. So charting analysis, on the other hand, which is categorized as an on-chart kind of technical indicators, are moving averages, Bollinger Bands, Ichimoku clouds, retracements of Fibonacci and extensions of Fibonacci we have covered in the past. They go on top of price action. Mechanical analysis are, in a sense, technical indicators that are gauging momentum or kind of sentiment or volume or whatever that is. They are found as oscillators, and most likely they are found below the chart on a separate window. Such examples are the RSI, moving average convergence and divergence, the MACD, ADX, which we're going to discuss today, and momentum alongside many other technical indicators. So ADX, let's get started. So the average directional index was designed by the legendary technical analyst or trader, Mr. Wilder, initially for commodity charts, but it was later modified so it could be used in other markets for various other time frames. So these modifications allowed the ADX to become what it is today, an indicator that tracks the strength of a market trend and analyzing said trends with the aid of additional directional indicators such as ETR, the average true range, and many others. So Wilder introduced the ADX as an indicator in his book called The New Concepts in Technical Trading Systems back in 1978, which revolutionized the field of technical analysis by bringing forth new ways of conceptualizing, but also quantifying market trends. Okay, so this is what we are dealing with today. He is the creator of the average true range, the ATR indicator, the relative strength index, the RSI index we have discussed in prior webinars, parabolic SAR, and many others, and they are widely used by traders till this day. And it's a safe bet to say they will be used in the immediate but also long-term future if there is no other groundbreaking kind of technical indicators being released. Okay, so ADX, what is the definition? The average directional index is a specific indicator used by technical analysts and traders in order to determine the strength of a trend. Okay, so as we mentioned many times in the past, trading, if you're new to this game, trading with a trend is the most or the basic and safest route you can undertake. So it's easy for you to just digest this as soon as possible and just go at this game, if you will, like you call trading, with this kind of thing in mind. If you master the, let's just say, capturing of movements of the primary trends, and you do that long enough and well enough, you can become very successful. And after that, you can go ahead and play the contrarian role, which you're gonna start predicting or gauging where the market is going to reverse and capitalize upon that. But the safest approach, if you're starting, if you're new to this game, is definitely trade with the trend. And all those euphemisms that go along or are heard throughout the markets, just trend is your friend and all that kind of stuff, are true, and they're there for a reason. They're set for a reason. So the help of or the appliance of these kind of technical indicator ADX onto your chart is going to definitely help you with achieving just that, if and only if you understand what information is conveyed and how to decipher its signal. So the trend can be, at the end of the day, going up or down, or the third example is sideways. And this up or down is shown by two indicators, and more specifically, we're talking about the ADX, aka the positive directional indicator or the positive DI, and the negative directional indicator, also as known as the negative DI. So for uptrends, positive DI is always going to be larger in value compared to the negative DI, and the opposite is also true. When your negative DI is the value of the negative DI is higher than the ADX, excuse me, not the ADX, but the positive DI, you are most likely seeing on your chart a negative move or a downwards trending market or an instrument. So that is an easy way to conceptualize what information the positive DI and the negative DI are conveying. So many times that these two are not so clearly far apart, and they're not conveying you the basic or traditional way of incorporating or deciphering these kind of events. Those kind of periods are what we call unclear at best, and they are most likely contributing to a sideways kind of fashion trend when it comes to a specific instrument. So at the end of the day, what we're looking at is a clear distinction or a clear difference or a clear gap or a clear rift between the positive and the negative DI, irrespective who has the largest value, in order for us to confirm that the market is moving either to the upside or to the downside. And this can be clearly seen. And if these are growing far apart, that indicates it's going to be an acceleration or a strength of the prevailing trend, either to the upside or the downside. If the positive DI is above the negative DI, let's just say the positive DI has a value of 50 and the negative DI has a value of 10. Clearly, by giving me these two values, I can assess or I can guess where the market is headed at. And if you accompany that with a value of ADX, which is closer or above the 20, so between the 20 and 40, the faster you're going to see an acceleration of the trend. And this is what we're looking for. So it is for this reason that the average directional index, which is the difference between, in a sense, the positive DI and the negative DI, is presented with three separate lines symbolizing each indicator. So each line is used to help assess a trade and whether or not it should be taken long or short or at all. Okay, so you can use the average directional movement, or the more specifically the directional movement index, in this kind of case the DMI, to see all three at the same time. So they combine positive DI, negative DI, and the ADX, and you have what we call an index named a DMI. It's the sum value of all these. and you can use this if the ADX is not showing positive DI, negative DI, which some cannot. So this is a quick template or a cheat sheet, if you will like, of how to interpret the values and the results that the positive DI, negative DI, and the ADX are giving you. So if you have an ADX value that is rising, this signifies a strengthening trend, something that you like at the end of the day. A falling ADX value is giving you an indication that the trend is weakening. So in order to conceptualize this even better, you have a midline or a threshold level, which is set at roughly around the 20 value. So if you have a value below 20, that gives you that the current trend is weak. If you have a value between ADX value between 20 and 40, that is indicated to be a strong trend. Okay, values of 20 and 40 of an ADX, it signifies a strong trend, and a value above 40 signifies or highlights or broadcasts an extreme trend. Okay, so ideally you would like to spot an early you would like to spot a trend at the early stages of its formation. So possibly you're looking at a chart or at an instrument that has a value roughly around the 20 level of an ADX, and you hope to see the ADX rising from there onwards, so going between 20 and 40 in order to signify and confirm the strength of a trend, and therefore validate your view that the trend is going to accelerate to either direction or the upside or the downside, and capitalize upon this. And maybe you will start paying attention for you to start pondering where to exit the position when and if the ADX value crosses the 40 threshold and goes to 50, 60 or whatever that is, because as we know, markets move in trends and they tend to follow their reversion towards the mean kind of rule, which is not a rule, it's an observation. It's something you can spot when you look at charts long enough. You tend to see that excessive moves tend to refrain and remove and reverse their course back towards the mean. If the mean actually gets updated, the markets don't move in either an upside fashion all the time or a downwards fashion all the time. They move in swings, they move in zigzags. So the ideal scenario here is for you to enter a position at the start of a trend in order to capture the largest portion of the move with the highest percentage change, and pay attention to where the move gets extreme, and therefore then start to plan your exit, expecting or extrapolating that the move is going to at some point in time reverse its course and come back down. And in order for you to safeguard as much as percentage gains as possible. That is the theory. In practice, it's much more hard to do so, but if you have enough experience and if you have studied this kind of indicators and trends and the markets and those instruments, how they behave, you can become much more accurate at timing the market and entering at an early stage and exiting at the peak or at the trough, depending where the market is headed at, with and capturing the largest portion of these kind of moves. We can do this in practice, hopefully, if we do have a valid example in front of us in the next throughout the duration of the next 3 or 4 webinars. We're going to do live trading sessions. Hopefully the market is going to be exciting enough for you to see how to actually capture these kind of moves using these kind of indicators we have discussed and put forth over the course of this webinar series. Hopefully it's going to be nice. Okay, so that is the cheat sheet. Let's go ahead and dive deeper into the basic components and do a breakdown of how this indicator works in order for us to actually conceptually understand how it is calculated, how it is composed, in order to first pinpoint the strengths or what kind of information we can rely upon, but also highlight what kind of weaknesses it has in order for us to patch up these kind of holes with hopefully the usage of another indicator or with our own judgment, keeping on the back of our minds that these kind of indicators are not perfect. They have flaws, and by understanding the flaws, you can calibrate your game accordingly, and your attitude, but also your strategy accordingly, in order for you to minimize unwanted and unwarranted kind of moves that are going to wipe off your profit or diminish it at very best. That's the best case scenario for you to have on the losing kind of things, the least amount of profits rather than just a wipeout or at the end of the day losses. Okay, so calculations, how we're going to introduce the components breakdown. Let's start with the calculations. Due to the fact that the ADX or the average directional index includes multiple lines, the indicator requires a sequence of calculations. They're not going to be done by you, they're going to be done by the software, the algorithm that computerize these kind of calculations. So all you need to do is understand what kind of calculations are done and also understand what information is conveyed. Okay, so the calculation are as follows. So the indicator starts off by calculating the positive move or by positive directional move, the positive DM and the negative DM, but also the true range, what we call TR, the true range for each period you are analyzing. And at the end of the day, if you don't know what positive DM is, this is calculated by the current high of any given instrument's price at this point in time minus the prior high. So if you have consecutive highs, higher highs and higher lows, that means that the instrument is obviously moving to the upside. If you have lower highs and lower lows, the instrument is moving to a lower ground. This is what the positive DM and the negative DM are calculating. Current high minus the previous high. If the current high is higher than the previous high, that is going to give you a higher value of positive DM, confirmation that the market is moving to the upside, if that is not clearly seen anyways by the chart. And the negative DI gets the previous low and the subtracts the current low. So you can use the positive DM when the current high is minus the previous high is, as a value is higher than the previous low, and the minus the current low is obviously going to give you a higher value. And you can use the negative DM when the previous low minus the current low has a higher value than the current high minus the previous high. Okay, so I'm sorry if I'm confusing you, but the calculation is super simple. So at the end of the day, you can spot this on a chart pretty easily. If you see today that specific stock or that specific commodity is making breaking into a higher range than the prior day, positive DM is going to be higher, negative DM is going to be lower when you have an instrument that has broken into a territory not seen in the prior session. Okay, and it forms a new low, negative DM is going to be higher. So therefore, if you sandwich those two together, you're going to get the true range. Okay, so the true range is the greater of A. You have a few options here. The current high minus the current low. So the highest the price action has gone within the session minus the lowest it has gone within the prior session. So the larger the difference, that means the larger the volatility, the more action it has had. Therefore, you can expect higher volume in this kind of instrument. And if the price action has closed, if the instrument price has closed above the prior close, that means there is enough bullish momentum. The price action is going to probably head onwards from there. The second option is when the current high minus the prior close is higher, or the third option is when the current low minus the prior close is largest. Okay, so the indicator then goes on to smooth your period averages, because you do that over a period of time, much like a moving average does the same thing exactly. I calculate how high the price action went and how low the price action went within the day, as we just discussed, with the positive DI and the negative DI. So when you smooth your period average of positive DI and negative DM, positive DM and negative DM, and the true range, then you insert the negative DM and the positive DM value to calculate and smooth the averages of those. Okay, so you get individual kind of values for each and every day, and then you smooth that out and you get, in a sense, what we call the positive DI, the line, and the negative DI, the other line that we are looking at when we pay close attention to the ADX as an indicator. Okay, so the first true range is the sum of the first and times the, okay, someone is writing a question. Okay, let's finish up. Times the true range readings, and this is number of. Okay, so you can call the X as n times. Okay, so the next true range value is the first minus the 1/4 of the prior true range plus the current true range. Let's not go into further detail on this. There's no point. And then you, in a sense, divide the positive DM value by the smooth true range value, smooth trade value to get your positive DI. Okay, so at the end of the day, the DI value is the sum, is the average of the calculation that we have with a true range with 1/4 times the current true range. I'm not going to go into the details. All you need to know is how to interpret it. This is for you to just look deeply if you would like. Some people find it not valuable. I do. If you would like to study this further, fair enough. So at the end of the day, the formula of the directional movement index is the positive DI minus the negative DI, what you need to know, then divided by the sum of DI, positive DI and the negative DI. All these are absolute values you must keep on the back of your minds, and not negative values that are subtracted by each other. They are using the absolute method in order to get these values, and then you multiply it by the 100. In order to get the ADX, you'll need to continue calculating the DX value as they come for each and every period you have selected, and smooth the results of the periods in order to get your first ADX value. Okay, so hopefully I did not confuse you. Let's move on to the gist of things, if you would like. So what you need to take from this, and what you need to pay attention from this, is that the ADX as an indicator, as well as the negative DI and the positive DI, are momentum indicators which help investors define, also determine the strength of a trend, but also its direction. Okay, it has a dual purpose. Yes, it gives you a directional kind of outlook of where the price action has headed so far, because we're dealing with past price action. There's no giving you information about what's going to happen in the future. They're telling you what is happening right now or what has already happened. So confirmation, the ADX gives you confirmation alongside the ADX, negative DI and positive DI. They give you an indication or confirmation that where the trend is actually headed at, but also they give you an indication of the momentum, which is how strong the current trend is. So ADX values, or the ADX as an indicator, projects market price, and it's clearly seen when prices are moving up, or when prices are moving up and you see higher highs and higher lows and you get higher closes. The positive DI is most likely going to be higher than the negative DI. When the prices move down, the negative DI is going to be, the value of the negative DI is going to be higher than the positive DI. Clear as fuck. Then there are crosses between both the positive DI and the negative DI line. This is the periods we do care the most about, because they are signifying potential trading signals or a possible reversal between the bulls and the bears kind of initiative. The bulls, for example, may be in charge, and then you see a crossover between the positive DI and the negative DI. That means the bears are challenging the bulls' reign, and they are attempting to take the initiative. This is what we care about. This is what capturing the early stages of a potential reversal are going to be looking at. Okay, the crossovers between positive and negative DI lines. Okay, they're not that rare when it comes to their formation, but not all of them are significant, and we're going to discuss how you can spot which ones are significant and which are not. Okay, so mere crossover is not telling you everything you need to know about a potential reversal. They are acting as a flag to tell you that, you know what, pay attention to this. Maybe we're going to have a switch of the power dynamic here, And if it is occurring, and if I see enough evidence, I'm going to go ahead and capture and place trades, and hopefully we're going to capture the acceleration of a trend, because the shift of the trend, and therefore from there onwards you expect that the acceleration of the trend is going to be undertaking. So a trend shows the most strength when the ADX value is above 25, 20, 25, somewhere in that range, which is a potential signal to buy or sell, depending which line is above, the negative or the positive DI. And a trend is weak, is signified when the ADX value is below 20. So nobody is in control. It's just a irrational or a kind of insignificant kind of interaction between the bulls and the bears. You need to have, in a sense, an ADX value north of 25 and a positive DI either between 20 and 40, and the negative DI below the 20 threshold, in order for you to call this a bull kind of run or accelerating kind of trend towards the upside. Or you can have an ADX value north of 25 and negative DI between 20 and 40, and a positive DI below 20, in order for you to call that as a bearish kind of move, or the projection or predict or extrapolating that the trend is going to move to the south. Okay, so you have to keep in mind that if ADX is below 20, it might not be the best or the ideal time for you to enter the trade. And if the market presents itself as not following a specific trend, this does not mean that the price isn't moving. Rather, it could be making a change in the direction or that is currently not present. Okay, you're going to see what I mean shortly. Okay, so in summary, the ADX does not indicate when the trend, whether the trend is bullish or bearish. The ADX, as a line we're talking about here, is not telling you whether the trend is moving to the upside or to the downside. The ADX is non-directional. It merely signifies the strength of the current trend. Okay, so the ADX is giving you how strong the trend is. The direction of the trend is given to you by the interrelationship between the positive DI and the negative DI. Okay, so if the positive DI is larger than the negative DI by large magnitude, that is telling you that the market is moving to the upside. And if the ADX value is also heading north of the 25, that gives you the definitive signal that the strength of that prevailing trend is going to accelerate. Whereas the opposite is also true. So the larger the value of the ADX, the stronger the trend is, and vice versa. And generally, an ADX value of 20 and below signifies a weakness in the current trend, whereas a value of 40 and above signifies severe and extreme trend. This is what we are looking for. Something else to take from this kind of slide is that the positive DI tells you what the buyers are doing in a gist. Negative DI tells you what the sellers are doing. Okay, so if the sellers are stronger than the buyers, possibly, and you have an ADX value that is north of 25, that tells you that the price action is probably going to fall to lower ground. You're going to form lower lows. The ADX tells you when, whether there is a trend, but also a strength. And remember, the ADX takes into account true range, i.e., how high prices rallied and how low they have reached, and it does not incorporate the open and close prices. It just incorporates trading range. So the highest of the day minus the low of the day gives you the true range. Okay, so the average true range is doing that calculation over the past X period of time. So combining the ADX with MACD, which uses close prices, may be a very enlightening and useful synergy of indicators that could provide traders with more accurate entry or exit signals, and we will see that in practice. Okay, so this is a visual illustration. What time? Okay, we have time. This is a visual illustration on copper futures. Back in February of 2024, we have spotted a shifting trend, and due to fundamental reasons, the rise of copper prices to higher ground. Okay, and you can see that signified. Let me find my pointer here, pen. Okay, so you can signify that with this kind of area right here. Remember, if you look at this from an overall kind of point of view, you can see prices being stuck between these kind of two levels for quite some time. And you can get the validation from the fall of the positive DI and the rise moving of the negative DI to the upside. That is gonna clash of, in a sense, this is in a sense signifying a clash of the bulls and the bears. Price action was expected to kind of be marginalized or just become neutral. This is the area of inactivity. As you can see, both lines are just moving close to each other and not either. They're not recording values north of 20. Okay, so none of the two was in control. So this is a period of insignificant kind of a random fluctuation of prices. ADX value has also plummeted from around the 30s down to the maybe 10. So loss of trend, weakness of trend, bulls or the bears. Neither the bulls or the bears are in control of the move, sideways price action. But from a point onwards, you can see a spike of the positive DI coming up there, the negative DI plummeting. You have seen a crossover there, and you see positive DI ranking values of above 20, so above 30 as well. So the direction was in the favor of the upside given this kind of move. And you see those two indicators, and the negative DI and the positive DI, the positive DI and the negative DI growing further apart. That means the sellers are getting out of the picture and the bulls are piling in long orders. ADX shortly follows with a spike from negative territory above the 25 and then surges to extreme levels, maybe has reached something like 60 or 70. So that signifies extreme bullish sentiment. The positive DI stayed above the threshold, but also further away. Look at this distance between the negative DI and the positive DI. The sellers were absent from this kind of move. And if you don't have enough sellers and you have supremely enough buyers, you're going to end up with a move like this. And you can see how fast the price action has risen due to the lack of sellers, but also the piling of long orders from the bulls. They were in control, and you can see also the crossover of the moving average of the short term and the long term as well, somewhere in here. Another confirmation. The long order was for you to enter the position. The long order was the most sophisticated, the option with a high degree of probability of becoming a reality given these indications. Okay, so you have an early signal down here with the crossover, the sharp move of the positive DI crossing above the negative DI, the confirmation that the positive DI remains in control and above the threshold, but also it grows further apart. The fact that the negative DI plummeted and continued to move further away from the positive DI, but also the confirmation that the ADX rose from below the 20 up to, let's just say, 20 and 40 at this kind of level. So an entry position for you may have been somewhere in here. Okay. Okay. The second wave of the ADX, this positive DI, but also the plummeting of the negative DI at this point in time. Okay, this is this was the most ideal place for you to buy. Okay, in anticipation that the price action is going to go up from there, and from at the point where you see the positive and the ADX turning positive, not positive, but crossing the 25, the 20 range and rising sharply afterwards. For you was their exit point for you, not there in this. No exit signal was enough, was present at this point in time when we took this snapshot of this instrument was in place for you. If you went long there, you would be still in this position, mainly because you don't see this happening. If you see the negative DI spiking and crossing the 20 level, albeit the ADX moving to lower ground. If you see the negative DI spiking, coming upwards, and then the positive DI doing this, then that is an area for you to consider exiting the position. Or you could use an RSI, which is much more calibrated to this kind of move, to see whether there has been some sort of divergence for you to highlight or keep in the back of your mind for you to exit for the time being. If none of this happens, you keep the position open up until the point you see a crossover of or a spike of the negative DI and a plummet of the positive DI, but also the fall of or the maintenance of the ADX at this kind of level. Okay, that is a primary area for you to exit the position. Until then, nothing of a signal was at place, so therefore you enter the position and you stay in that position long enough. Okay, so this is a visual illustration of the negative DI being the a primary contributor, or the direct, or the sellers being the taking the helm or having the let's just say the initiative of this kind of move. So in this point in time, we have seen the signal after unfortunately a paradoxical decent enough earnings results from Snowflake. It's a daily chart of Snowflake. After its earnings report, which was better than expected, for some reason we have seen its prices opening up with a gap down. Okay, that was actually the open after this kind of session. And the reason why, because we have seen a negative forward guidance or a negative outlook from the company going forward in the next quarters, you would reasonably expect to see this kind of plummet after an earnings release that, even though it has beaten expectations, the forward guidance, the future looking prospects of this kind of company were not good as per their earnings results, earnings report. You would reasonably expect to see such negative reaction. And we have seen instantaneous, the negative DI spiking, the positive DI plummeting. This is the crossover that we were talking about. Negative signal was given here. And the fact that the negative DI stayed at this extreme level around the 55 level, the 50 level, and the negative and the positive DI, venturing below the 20, this is the indication for you to go short. Okay, the ADX was already elevated at around the 30 level, so that is going to tell you that the price action from there onwards is probably going to head south. Okay, now the ADX at this point in time has kind of waned out, and you can clearly see that from stagnating, okay, kind of moves here. Price action did not go anywhere. It has stalled, even though it has been moving to the downside, not at a fast pace because the ADX was plummeting. And another case can be seen once again from Snowflake, this time disappointing with its earnings, negative outlook going forward. Once again, double the trouble. So if you miss this kind of move, the next one would have been somewhere around here, because once again, after you see this, which could have been your exit, which is somewhere around here. Okay, sell there, here, and cover your position here. The next place for you to go short or sell is at this point in time, once again, after their earnings results, where you see again the negative DI spiking, the positive DI plummeting, and the ADX once again on the rise. Okay, that signifies that the negative DI signifies that the sellers are in control, the buyers are out of the picture, and the rising ADX gives you indication that the strength of the trend is going to continue going down. This path is going to accelerate. And you can clearly see that by the fast fall of prices, but also from this has acted as a support level, the break below this kind of level. is another confirmation for you to see that the price action is going to continue falling from there onwards. Okay. Last example is when you have the ADX flatlining and you have a trendless market, because neither the bulls or the bears have a sufficiently strong value. Okay, so you can see that from a highlighted point of view, ADX plummets, so it's below the threshold. Okay, nobody cares. No interest in this kind of company, Sagimet Biosciences. After this kind of spike, you can clearly see here, no interest for this company whatsoever, and you can see a trendless market. So ADX value plummets, no strength or either to the upside or to the downside, because neither the bulls or the bears are in control. The volume is not there, the volatility is not there, because there is no enough interest. We stay away from this kind of instruments up until the point we see a definitive rise of the ADX, mainly because around this area. But again, it's too hard for the price action to rise. Okay, so at the end of the day, you see, yes, positive and negative DI being intermingling like snakes. Okay, ADX value is below the 25. Neither the bulls or the bears are in control, irrespective of the crossovers. No pickup of price action. No need for you to enter this kind of trade, because nobody else, at least there's not enough people for creating the necessary conditions for either a rally or a fall of price action. Okay, so we stay away from these kind of instruments because they have no percentage gain for us to contribute and for us to capitalize upon after at least this kind of move, where you could clearly see ADX rising sharply, super sharply, negative DI, excuse me, the positive DI rising sharply, the negative DI falling away from this, so divergence, okay, moving apart from positive and negative DI, and you see the ADX value sharply higher, creates these kind of conditions. Okay, again, no, not nicely, because it has done the jump. This is probably a pump and dump kind of play. That is why we don't trust this kind of companies and their performance. That's why we don't allocate capital on this and expect price action to move either to the upside or the downside, expecting that the positive, excuse me, expecting that the ADX is gonna pick up from there onwards. Okay, learn the past history of this company. We do pay attention to it if and only if there is enough interest by the market. Okay, so this brings us to the end of today's session, guys. If you have any sort of questions, please send them through. I'm going to be more than glad to answer them. I don't see any questions in the Q&A or the chat. Again, you guys, you can find this webinar online on YouTube. Probably it's going to be uploaded shortly after the end of this webinar. If you have something being unclear, please watch this webinar once again. If you still have questions, please send them through. But I'm going to cut this session short, and thanks for watching, guys, and hopefully we're going to catch you on to next week's webinar. Probably we're going to do a live trading session. Hopefully we're going to see you there, and market is going to be exciting enough for us to go ahead and just trade. Okay, so again, have a lovely weekend, guys. Thanks for watching. Ciao, ciao. Bye-bye.